Hello everyone, I'm Edwin. I'm very happy to see you again in personal finance and investment. Last week, the stock market experienced a significant adjustment. Many stocks had fallen sharply, especially for technology stock. Elon Musk lost his world's richest man title after Tesla punched. In a single week, we find that Tesla fell 15.6%, ARKK fell 17.1%, Tencent fell 11.8%, and Meituan fell by 24.6%. Some small or penny stock even dropped by more than 40%. But did the market perform really badly? Let's say Hang Seng Index fell only by 5.7%, Nasdaq dropped by 5.1%, and S&P 500 dropped only by 2.4%. So we can see that investor risk exposure can be greatly reduced if investor invest in market portfolio instead of individual stock. And it is actually consistent with Warren Buffett's advice that the best investment vehicle for retail investor is to buy S&P 500 index fund. He pointed out that there are three advantages. First, since S&P 500 index allow investors to indirectly hold stocks across different industries, so there's no requirement for superior stock picking skill. As long as the economy is growing, a stable and attractive returns can be expected. And second, as index fund contains a large number of stocks across different industries, investors can benefit from the diversification to achieve higher return to risk trade-off. And third, investing in index fund can save investors the cost of trading. Therefore, he recommends that investors should invest 90% of the index fund. For investors who are not that confident on their stock or fund picking skill, I would recommend one step further. Like what I said in previous video, I suggest investor to invest 100% on index fund. Many people may think that is it too extreme to invest 100%? Is it too risky? But I would say that this strategy is actually less riskier than investor who invest 40% on individual stock and putting the rest in saving account. But the explanation takes time, so maybe let me explain it in another video. Then, in the following part, I will further elaborate the benefits of investing in index funds, why Warren Buffett so recommend. The key advantage of investing in index funds is to diversify portfolio risk. So let's say when our holdings increase from one stock to 5 stocks, and since each stock has its own firm-specific risk factor, therefore their price movement will not be the same, and some losses can be offset by gains from others, and it helps to greatly reduce the portfolio volatility. And also, the effectiveness of risk diversification can be increased with the number of stocks included in our portfolio increase until our portfolio reaches to the point that it covers companies across different industry and with different type of characteristics. In this case, we can lower our risk exposure to a considerably low level. Of course, people may say that, but it simply implies a lower return. Let me answer this question with the following example. Assume that the average return of each stock is 10%, and we know nothing about which stock is going to go up and which stock is going to go down. So then it simply implies that the expected return for each stock we invest would be 10%. So if we invest in 5 stocks instead of one stock, as the expected return of each stock is 10%, so the overall return of the portfolio will still be 10%. But as the volatility of stock in the portfolio offset each other, the risk can be greatly reduced, so investors can achieve better risk-return trade-off. And we can see that when the number of stock hold increase, the expected returns would remain the same, while the risk is getting lower. So we can benefit from the diversification to get a high return to risk trade-off. And it actually explains why index fund could be a good option to investors. The second benefit of index fund investing is the low holding cost or low trading cost. Buffett mostly recommended index fund is this one, which called Vanguard S&P 500 ETF. Its annual management fee is only 0.03%. So let's say if an investor make 2 trading a month, and let's say the cost is low as 0.1% each time, then the annualized cost is already 2.4%. In other words, if investors want to outperform the index fund, they have to achieve 2.4% over the market. Third, the similarity between stock picking and Texas poker is that profit mostly go to players with superior skill. But what makes them different is that you do not really need to be skillful and knowledgeable to gain from the market. As long as you buy an index fund, you can get the average return of the market. And instead, if some investor want to get better than average returns, they have to be sure that their technique is good enough to allow them to generate additional return that can cover their transaction costs. As there is a large number of investment banks, hedge funds, mutual funds trading the market, they have tremendous capital, supercomputers, and talents in the field to absorb any mispricing in the market. In this case, we need to think about how much time and resources do we have to spend to be able to compete with them in absorbing those opportunities. And moreover, what is the probability? I hope you can think about these 2 questions. In case you are very confident, definitely you can go for active investing. Otherwise, I would suggest passive investing to you. Although Buffett did not mention about this last point, but I think that is actually very important. It's about releasing your pressure and then releasing yourself. The market make adjustments several times a year, as what we encountered last week. If you invest in individual stock and if you actively trade, your mood will definitely be influenced by the market up and down. For example, investors may blame themselves of missing to sell the stock before it crashed, or sometimes they feel regret on selling their holding too early. After they find that their holding increased after they close their position. I can't really remember how many nights I cannot fall in sleep just because the market fluctuation. On the other hand, if you invest in an index fund, you will feel much peaceful because you use buy and hold strategy, so you don't really need to think about the time you buy, the time you sell, and you also know that the stock market will always go up again after any crash. Especially nowadays, governments are more eager to use expansionary monetary policy to stimulate the economy. Even the market crash, when the government immediately use quantitative easing, the stock market will rebound soon. So just like the US stock market achieved its historical high in the mid of last year. Some investors may argue that the Japanese stock market is still far below its highest 30 years ago. Yes, that's right. So I would say that picking the right market to invest is also requires some techniques. And so let me talk about how to select index fund, or can I recommend some good index fund to you in next video. So to sum up, the index fund allow investor to diversify away some of the risk, and also it help investor to lower the cost, and then it does not require some investment skills. Moreover, it can help you to release your stress and then anxiety, so that our life can be more peaceful. And moreover, investor can save your time on learning investment and watching the market, and to do something else like spending time with family, traveling around, doing voluntary work, watching Netflix, or watching my channel. Okay, so thank you so much for watching personal finance and investment, and I hope this video helping you to make decision on investment. I'm Edwin. I'm looking forward to see you again on next video. Bye.